ועכשיו,
And now,
לראיון מיוחד,
for a special interview,
and I'm honored to invite Christian Gattiker Ericsson. He is Chief Investment Strategist and Global Head of the Julius Baer Bank in Switzerland. את הראיון יקיים
the interview will be conducted by Shaul Amsterdamski, senior journalist, financial columnist in CAIA, the Public Broadcast Association.
While I'm pouring water, I'll say hello to everyone. I'm glad to be here together with Mr. Ericsson. Thank you very much for sharing your time with us, and thank you for the Swiss ambassador who is honoring us while being here. Thank you very much. We're in Israel. We're accustomed to think of ourselves as the focal point of the universe, which is sometimes true, but most of the time isn't. So today, I'm very glad that I have the opportunity to talk about the world, the global economy. So we'll start from talking about that, and then we move a little bit, we'll dive deeper. At the end, if we'll have enough time, we'll talk a little bit about what's going on in Israel in these days. So to kick off, let me start with a simple question. 1 year from now, where do you see the global economy in terms of inflation and interest rate? And if you can differentiate your answer between the US and the EU.
Thank you, and thanks for having me. Yes, I think, a year ahead, I mean, that's quite an ambition if I think of my colleagues who spoke in the morning. Giving forecasts is a dangerous business. But of course, we have to have an opinion, and our opinion is that the world economy as a whole is much more resilient than many might think, especially after this crisis. And if you ask me about the year ahead, I think the US will be close to a recession. I mean, pretty soft in terms of growth, and the European Union will hang in. And overall, I think the biggest differentiating factor is the one we haven't spoken yet about, but that's China. I think China will stabilize a lot on a global scale, and we probably will just be close to a recession. But unfortunately, to all those doomsayers, I think it will not feel like one. It will be quite an eerie one, a special one. And this has a lot to do with what happened or what the trigger is. Because the trigger has been, for the whole thing, has been overstimulation of the global economy. Now we had to remove this stimulus after the event, and now we're basically trying to find the post-pandemic normal. A difficult process, but completely different to anything we've had in the past, maybe even 100 years.
So that's rather an optimistic view. Would you agree? Because as you said,
yeah, in relative terms, yes.
What makes you optimistic? Relatively
well,
speaking.
First of all, I think that the expectations are extremely low. I mean, if you take a bit the bigger picture, I think I haven't seen such a bad mood and lack of optimism for the future since the early 1980s. I mean, it's really kind of the no future. I don't know how the youth here feels about, but we have a youth that calls itself the last generation. That's pretty much the punk movement in the 1980s, which is no future. I think that's at least, the bar is low. And secondly, and maybe more in economic terms, I think we still underestimate how the situation is with households. In particular, in Western economies, the US, completely different picture. With actually the lack of growth in the US in the past 10 years has been to a large extent to the fact that the consumers have been deleveraging. So they pay back debt. And that's the lowest level ever on top due to the pandemic. I think the colleagues put it very nicely. Due to the pandemic efforts, the savings are extremely high. So basically you have the lowest debt levels in consumer, in households, private households, combined with the most liquidity. And given the fact that Western economies, I think the Israeli economy is no exception to that, are driven by 2/3 by consumption, you have to look what the households, the private households are doing. And our case is they are just fine. I mean, the next thing, and Professor Rubini is absolutely right about that, I think the government debt situation will come to the fore in the years to come. But that is, in our view, by no means the topic for the next 12, 18 months. Here, we're still kind of finding our way into the post-pandemic normal.
Interesting. So, if anything, you're saying if we manage to have a soft landing and come out of it relatively okay, maybe we are at the beginning of a new era of growth and, I don't know, reaching high, new peaks. And
that's very, very well possible. I think, we as a profession, the economists as a profession, we have a bad track record in figuring out where growth comes from.
And it's very, very dangerous for economists, especially for ones that try to forecast the future, to be optimistic, right? You'd rather be optimistic and,
of course. This is always about being a Cassandra because, if you're wrong, they basically clap your back and say, well, it doesn't matter. If you're optimistic and you're wrong, you're in deep trouble. Yeah, but I think, and I think that's still underestimated. There are people out there who do not care about the government debt level, who simply want to live, and especially after this situation. And maybe there's an analogy in that sense to the Roaring '20s, where if we stood here in 1923. Probably making positive forecasts about the global economies would have been a difficult job.
Yeah.
Yet, we saw that some of the most amazing things happened. And I think we're by no means done in terms of growth, catch-up potential. I don't think that there's a lack of labor in the world. I think emerging markets have been in crisis for the past 10, 15 years. Maybe the surprise can be that emerging markets are coming back in. And I think a lot of that is tied, and that might sound boring, but a lot of that is tied to the US dollar. I mean, the US dollar, the strength of the US dollar shows you where capital is flowing. The dollar is the global reserve currency, so the best thing that could happen is that the dollar weakens. It would show you that the money is finally, after 15 years almost, finally flowing into the rest of the world and not being monopolized by the US economy. I think that would be the real thing. And by the way, I think that could be one of the blessings in disguise of this whole banking crisis we have in the United States, that finally, something went wrong in the US as opposed to the past few years where everything went wrong elsewhere.
Although we saw it in Switzerland as well. Credit Suisse.
Indeed. Usually we're not the beneficiaries of the, we're just the kind of the alternative, the small alternative to the US dollar. There's safe haven currencies and there are risk-on currencies. And the Swiss franc certainly used to be, or is still perceived as being a risk-off, safe haven type of thing. So the real beneficiaries are emerging market currencies. If you see that the real is going up, if you see that the rand is going up, if you see that the Indian rupee is going up, that tells you that finally, we see a turn of the tide. And I think, this could be something which then kind of gets into a more dynamic global economy than we had it in the past 10, 15 years.
If you mention the banks, is there, and we saw some bailouts of, well, not bailouts, but buyouts of relatively small regional banks in the US and one in Switzerland. Is there a systematic risk there? Will we see a financial crisis starting in, I don't know, a few months?
We don't think so, and we have a hard time kind of getting the contagion effects right. Our scenario for this, what's happening is the savings and loans crisis. That's a long time ago. That was late 80s, early 90s. And I don't say that this is a repeat, but it has a lot of similarities because at the time it was about smaller banks, regional banks in the US that had a problem. At the time it was real estate related, but it was a particular thing which was in smaller banks, and it took forever to basically sweat it out. The big guys in the US, the rest of the world, were almost unaffected by the whole thing. And we think that's a parallel. I think it's a regulatory slip that happened. Some blame President Trump for being too lax about regulation of the smaller entities. The big guys had their stress test, and it seems, and this is also the same perception with one exception in Europe, that the regulation actually holds. And therefore, looking at the capital ratios of banks, where they are, And as we said, the private households, which is basically the counterpart, being in very safe space, we have a hard time having this playbook of a repeat of the great financial crisis. Simply the system is too stable at this stage.
Okay, so if you were drafting a memo to investors, okay, and you were mentioning all of the upside factors, and still you need to write something negative, one thing, what will be the main risks that you see that the global economy faces today?
Tactically, it's simply that central banks overstretch it. They simply overdo it, and I think we're pretty close to that level. You know, we have this kind of 12 to 15 months until the central bank policy actually hits the economy. So there are huge lags. And we basically have a slowdown anyway in the book. So any additional burden from central banks would actually increase the risks of derailing. And in our view, it's not necessary. So I think there's policy mistakes is the number one risk.
So if I'm hearing you correctly, and correct me if I'm wrong, you think that the central banks, especially in the US, I guess, need to, stop hiking the interest rate upward?
They should have stopped a while ago. I mean, I understand that, you know, also the central bank here and the Europeans have to kind of match the rate trajectory of the United States, because otherwise your currency decrease, and then you have another inflation problem.
And the EU is long way behind.
But you know, by no means they are in the same situation as the United States from a domestic point of view, and also given the debt levels of their member states, I think, you know, completely different ball game. Europe is more like Japan, and Japan actually had, you know, low rates forever. Again, you know, I think, and you know, this always sounds to be very much smarter than central banks, but we'll just look back and realize central banks reacted to an earthquake, an external shock, the pandemic, by kind of fighting a great financial crisis, which was basically a systemic issue. So saving the banks, financing the government, and so forth. So they had to scale back, and they're behind the curve in our view. So what they've done is good enough. We have good indications. I mean, the colleagues in the morning showed the charts. You know, the supply chain disruption is going back. Inflation is normalizing. We'll be there anyway. The rest is simply kind of yielding to political pressure at this stage. And I think this is something which makes us a bit uneasy about.
That's interesting, because I would imagine that most politicians would want central banks to lower interest rates, not to increase them, because, you know, it stimulates the economy, it lessens the burden on the households. You say it's political tension that drives the interest rate upwards?
That basically drove it up in the first place, because it turned out that central bankers were too sanguine, at least in public perception, too sanguine about this transitory inflation, which proved to be a monster inflation wave. And then they had to kind of catch up. But I mean, if you remember the chart in the morning, and finally now the official inflation rate in the US has crossed the target rate. So in other words, you know, the Fed is higher in terms of rates than the inflation rate, and the trend is down. So I think that's a good case now. And as you described rightly, you know, the perception has shifted as well. You know, there's now finally first voices that say, finally, we should be thinking about normalizing rates to the downside. So in our view, 18 months ahead of the US elections, the Fed will try not to rock the boat. So neither will they increase further, nor will they start, unless they have really major pressure. But you know, if our scenario plays out, they will not start a cutting cycle again. They try to keep the situation as stable as possible, not to be kind of taking sides when it comes to the electoral race.
Interesting. Let's move ahead in time and talk a little bit about the long term. You mentioned China before. We saw the world, even before the pandemic, starting with the Trump administration, I guess, moving towards deglobalization. The tariff wars and other stuff like that, and then it's just increased during the pandemic, and have been going on since. Is that the trajectory that we're heading at, like, I don't know, for the next decade of deglobalization? And if so, what will that do to global trade, the global economy?
You know, I'm pretty puzzled by this discussion because I can see deglobalization everywhere but in the data. It's everywhere but in the data. Basically, you try to find where is deglobalization happening and you can't prove it.
So you're saying it's just us journalists who would like, to find titles?
No, it's also politicians capitalizing on kind of fears in the audience. I never target journalists because I think they're just a reflection of what works in public. So I think, it's really something which is probably kind of overstating globalization as it was, because suddenly 50 years or 40 years after the globalization trend has started, everybody thinks this was such a wonderful process, such a smooth thing. No, it was completely chaotic and disruptive. And by the way, I think it's good news, again, talking about emerging market currencies, good news if so-called deglobalization happens for the Mexican economy, because they were basically killed by the Chinese competition. And I'm pretty sure, given where production processes are these days, a lot of production will move to Mexico instead of. So nearshoring is a theme, but also there's big labor pools, not the least in India, which seems to be the main beneficiary of these kind of global skirmishes and wars, which has an almost unlimited labor force potential, and I think we'll see a lot of that basically coming back in. So, if you look at shipping rate of containers, if you look at share of GDP which is exported on a global scale, everything is still up. I mean, I fully understand where people are coming from. I just can't observe it in the data.
Okay, so let me ask it differently. If we're looking at the upcoming decade, or I don't know, up to 2030, okay, what will shape the global economy? What will be the main forces that will affect the global economy? Is it the China-US rivalry, anything else?
Yeah, on a political side, again, we have a slightly different view to the current kind of blueprint of the world being in a kind of a Cold War 2.0. I think multipolarity basically hits it more on the nail, and that means a lot of things being in flux. Quite unfortunate. I think this creates a lot of uncertainty, and also in terms of digesting the news flow you get hit with every day, it makes it a lot more difficult. I mean, just to give you a flavor of what I'm talking about, there are lots of nations basically arbitraging the system. If you take Saudi Arabia, they do it masterly, how they treat the US on the defense side and how they treat the Chinese on the oil side. France, for instance, did a first try, by questioning whether they should have a policy of their own with Macron. Everybody completely shocked by that. But I think, we see a lot of that, and that creates a lot of opportunities. And I think, even in a maybe less strict system, there is enough for technology and innovation to play out, and therefore we're quite optimistic in the medium to longer term.
Okay. We're heading towards the end of our conversation. I have somewhat you know what, I'll ask the serious question and then a silly one. Let's talk a little bit about the Israeli economy. I don't expect you to be an expert on that, but in principle, if investors are looking from the side on an economy which was booming and everything is great, the macro economic parameters are perfect, but the government might be taking it towards a less democratic, on a less democratic path, what will that do to investors? Will that affect their investment strategies? I don't know.
I can't claim, I mean, I don't speak for all the investors in the world, but sure. I'm afraid, they're quite morally neutral. So, in other words, what they like is security and safety for their investments. So you can change the rules a lot, but then you have to keep them and stick to them. And I think that's what this is about. To me, this is like, maybe far-fetched, but it's like Brexit. I think Brexit will not keep investors away forever, but unless you have clarity what the new set of rules are, you basically stay on the sidelines, and then you look at it, you look at the cost, the price, the currency, and then you step back in if there's potential.
Okay, one last question, a silly one. my firstborn just turned 13. He had his bar mitzvah. He got a lot of money for his birthday. If you were his dad, and looking way into his future, where should he invest? Not specific stocks, but where? I don't know. He wants to be a global man someday.
My younger son just turned 18, and becoming an adult means that you basically are now in charge of what parents and grandparents put aside. And my father-in-law, who was a banker as well, he put everything into stocks for them and paid in. And my mother, who's more on the conservative side, she was on a savings account. Actually, I can tell you, the real return was 4%, nominal 4% versus 120%. So I would strictly go into smaller cap, global growth stocks, and that's the problem with young people. Don't look at them for the next 20 years.
That's right. Christian, it was an honor. It was a pleasure. Thank you very much for talking to us.
Thank you. Thanks a lot. Thanks, Shaul.